Good afternoon, everyone. Welcome to today's webinar, Trading Earnings with Limited Risk. My name is Scott Green, Marketing Director with Regal Securities. And shortly, I'll be introducing our main presenter, Tony Zhang with OptionsPlay. Today, we'll be going over what is trading earnings, quarter two earnings preview, options pricing around earnings, strategies to limit your risk, and more. OptionsPlay, for those who are unfamiliar, is a tool on your trading platform to help you with analysis, strategy, and research for your trading options. It's highly integrated with your trading platform. And for today, after I introduce Tony, he'll be going over OptionsPlay and trading earnings for options, and then we'll have about 15 minutes of Q&A at the end. Just want to take a moment to share this disclaimer. The types of securities, forms, and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell any options. This webinar will be recorded and is not intended to be used for individual tax, legal, or investment planning advice. So now I'd like to introduce the OptionsPlay guru, Tony Zhang, Chief Strategist. Tony has many years in the financial services industry. He oversees the OptionsPlay developers, and that team has led to some of the most innovative tools in options trading and analysis. OptionsPlay is currently embedded within several major sell-side brokerage firms, as well as a direct-to-consumer platform. Tony has helped build up the product suite and bring it to market and self-developed and manage many of OptionsPlay's partnerships. And before Tony begins, just want to share with those who are unfamiliar where you can find OptionsPlay in your platform. There's tabs across the top, and one of them should say OptionsPlay. If you're having any trouble, please reach out to your brokerage customer service team. They'll be able to help you find it or address whatever questions you have. And with that being said, I will now turn it over to Tony. Tony?
Thank you, Scott. Thank you, everyone, for joining me this afternoon. Like Scott said, today we're going to be talking about how to trade earnings with limited risk. I want to thank everyone for coming back to our educational webinar series. This is going to be an exciting one considering earnings season is coming up. I'm really happy that we're talking about earnings season again because it seems like we've gotten a bit of whipsaw over the last few weeks talking about different things that are driving the markets. All this talk about trade wars, whether it's going to impact the markets to the downside or the upside, we've certainly experienced both sides. So it's really interesting to look at corporate profits again and focus on what really drives equity pricing. The thing about trading earnings is that earnings does move the market significantly, which does mean that there can potentially be a lot of risk when you're trading around earnings. So today what I want to show you guys is how to go about analyzing trades using options so that you can take bullish and bearish views on stocks going into earnings with limited risk. And the key here today is to make sure that you guys understand the tools that are available to you free of charge at Regal Securities that you can utilize to instantly look at some strategies and quickly decide whether you want to take an earnings play or not. So I'll talk about what to look out for when you're trading earnings, but more importantly, what I do want to spend the most amount of time is actually showing you the tools with some real examples so that you can start being self-sufficient in doing your analysis for trading. And the tools that I'll show you guys here today is not limited to just trading earnings. You can use this for trading all types of strategies. But today we're going to be talking about the context of what are the best practices for trading around earnings. So what I'll cover here today is we're going to first do a quick earnings season preview. I'll talk a little bit about what we saw last quarter, what our expectations are going into next quarter, what we're seeing is in terms of overall trends for the Q2 earnings season. I'll talk a little bit about what is trading earnings for those of you that have never traded in earnings before. I'll talk about why you should consider trading it, and lastly, how to trade earnings effectively. And that's really the key part here is how to trade effectively, meaning how do you take bullish and bearish views on a stock going into their earnings announcement with limited risk and having the proper tools to understand exactly what your expected profit and loss is if the trade works out and if it doesn't work out. And like I said, what I really want to spend most of the time on is showing you some real live examples of stocks that are about to have earnings announcements in the next few weeks and show you how you would utilize the tool to analyze whether you should take a bullish or bearish view on that underlying stock. So let's jump right into the previews. So first I want to start off with just a quick recap of what happened in Q1 of 2018. Very strong quarter, both on sales and earnings. So this was actually one of the strongest quarters ever recorded in the history of the S&P 500. And this was, what's interesting about that quarter is that despite having one of the strongest quarters, the S&P 500 didn't actually move any higher during that time. And this is actually fairly common in what we consider late cycle, or what we see late in the business cycle. We've been in a bull market for almost 10 years now. So typically in this late stage, we typically see even though stocks are outperforming their corporate or increasing on sales and earnings per share, stock prices aren't moving much significantly higher. So it's interesting to see what this season is going to bring. The big headline for the Q1 was actually the tax reform. So we recently passed a very large tax bill that was beneficial to corporates. And what was interesting was to actually see the actual impact in tax rates. So in Q1, we saw the average S&P 500 stock only paid 19% effective tax rate versus 25% before this tax reform. So that is what is going to have a huge impact on the markets in Q2. Namely, mostly in the form of capital expenditure. Companies now have more money to potentially put towards research and developments and new products and spend to grow their business, and potentially buy back their shares or return some of those back to their investors in the form of either buybacks or dividends. So that is something that we think is going to have a big impact for Q2. And like I said, one of the biggest headlines for Q1 is, despite the strong quarter from corporate profits perspective, the performance was very muted for stocks that did have positive performance. However, the overall reaction to stocks that missed their corporate guidance was a huge negative reaction. So stocks that miss got punished significantly more versus stocks that did beat did not really get that same positive alpha. So that is, again, what we typically see in these types of late cycles, 8-9 years into a bull market. So what are our expectations for Q2? So far, where our expectations are, again, a very strong quarter. Macroeconomic indicators show strong industrial activity. We expect that both sales and EPS to be fairly strong this specific quarter. Tax reform, again, is going to be a big potential boost to the markets this quarter. Increases in capital expenditure, increases in buybacks, increases in dividends. These are all supportive of higher stock prices. So these are the types of things that we're expecting for this quarter. And lastly, the guidance that a company provides is really the template that we want to use for what our expectations are. Meaning, whether a stock beats or misses tends to not have the same effect in these late cycles as company guidance. So if a company guides higher, we're likely going to see follow through of that stock. So even if a stock beats or comes in line with their earnings, but they guide higher, we typically will expect that stock to continue moving higher, or if they guide lower, we expect the stock to move lower, regardless of what we're seeing, whether they beat or miss. So that's kind of the theme that we're going to see in Q2 of this earnings cycle. So now that we have an idea as far as what our expectations going into the next earnings cycle, which is just starting, let's take a look at kind of what sectors are scanning, or what sectors are looking good for this specific quarter. So the sectors that we're seeing good upward revisions, so meaning these are companies that are guiding higher on both sales and earnings per share, are healthcare, technology, and materials. Technology has been a strong sector for quite some time. Healthcare is actually just starting to come becoming a little stronger over the last few weeks. Materials is actually something that's just started to kind of really come to life over the last month or so, versus downward revisions is really utilities, consumer staples, and telecommunications. So telecommunications and utilities tend to be very interest rate sensitive. We saw a pretty big hit. We actually saw a pretty big increase in these two sectors over the last month or so as interest rates really came back down. But as interest rates started to climb a little higher today, we saw big losses in these types of sectors. So we kind of see that trend continuing going into for the reporting for Q2 earnings, as utilities, consumer staples, and telecommunications are likely going to underperform going into this earnings cycle. So what is trading earnings? So this is really for those of you that are relatively new to this topic or maybe have not traded earnings before. Earnings is simple. It's really when the company reports its revenue, profits, and forward guidance. Companies do this once a quarter or 4 times a year, and they start in July for the Q2 quarter. Usually we have a lot of banks that start off the quarter, so a lot of the banks will be reporting in the next few weeks. We'll be looking at a couple of those. Healthcare stocks, these are the types of stocks that typically report early, and this provides us with some guidance as to what the whole quarter is going to look like. So the first week is actually really, really important to follow and understand, is because it's going to provide you with a template of what is likely going to happen for the rest of the quarter. Now, why should you trade earnings? Now, trading earnings is not for everyone, because earnings is one of the largest earnings creates the largest volatility for stocks each year. So the 4 largest volatility events typically is the earnings announcement for each stock. So what this creates is a binary tradable event, meaning a single event that causes a very quick move in one direction or another that is tradable by you. Now, how should you trade this? The best way, in my opinion, and that's what we're going to show you here today, is using options, because using options allow you to take a bullish or bearish view going into earnings with limited risk. So we'll talk today about the 2 strategies you can use to take this bullish or bearish view, how to analyze it using OptionsPlay. Now, when you're trading earnings, you typically want to trade expirations that are at least about 2 weeks after the earnings date. So if you're looking at different options to trade and you're wondering which expiration should I choose usually at least 1 to 2 weeks beyond the earnings date to give yourself a little bit of time, so that if the stock does take a bit of time after the earnings to make its move, a lot of times stocks will follow through for 5 or 10 days after that earnings. You want to make sure that you're able to capture that. So that's why you usually want to use an expiration that's about 2 weeks beyond the earnings date. And lastly, you want to use buying call or put options to speculate on direction, because it allows you to take a directional view with limited risk. So we'll go a little bit into detail about those strategies next. So when we're talking about trading earnings, it's a risky strategy, and it's a strategy that's not easy. And I want to make that clear to everyone before we move on to talking about actual strategies. Trading earnings is tough, and it's tough because it's what I call 1 step forward, 2 steps back, because you have one thing working in your favor while you always have 2 things working against you. So when you're trading earnings, when you're buying a call or a put going into earnings, what you need is the stock to have a large move on a beat or a miss to in your favor. So if you expect a beat, you buy a call. If you expect a miss, you buy a put. And you need that stock to move in that direction by a significant amount in order for you to profit. How much do you need it to move by? You actually need it to overcome 2 different things. There's 2 things working against you while you're buying that call or a put. You have volatility crush that happens right after announcement. This is where the implied volatility of an option collapses right after earnings, because implied volatility is very high right before earnings, because there's a lot of uncertainty as to what the earnings will look like. So the options price becomes elevated because of this uncertainty. And once that earnings announcement comes out, that uncertainty goes away and the implied volatility of that option collapses. And what you get is a significant reduction in the price of the option with all things else held equal. So even if the stock doesn't move anywhere, you still have this loss in the option premium because of this loss in volatility. The second piece is you have time decay always working against you. The longer you hold on to an option that you've purchased, the more the time will decay and the more of the option you will lose to time value. So these two things are always working against you when you buy a call or a put. And in order to make your money on an earnings play, that large stock move has to overcome these two things that are working against you. So what that means is that out of the 4 different possibilities that you can choose, only one of them will provide you with profit, and the other 3 will typically result in a loss. So that's why trading earnings is a difficult thing to do, which is why we want to make sure you guys understand how to analyze an options trade or how to analyze an earnings trade, making sure that you have the tools to do so, and understand what are the different factors that affect your options trade before you go trading an earnings announcement. So with earnings, you can really basically have 4 possibilities. You can either pick the right direction and the move is large enough in your favor to overcome this volatility crush and time decay. That's when you can profit. However, there's also the possibility that you call the right direction, but the move just is not big enough. So a lot of times a stock can move 5, 10, 15% on earnings, but there's plenty of other times where the stock might only move 1 or 2%. And if that's the case, likely that you may still end up losing money on this trade, even though you called the direction correctly. You might have believed that the stock was going to beat, and it did beat the earnings, but the stock just didn't move much higher. Maybe the market had already priced that in. So that's something that you always have to consider, is not only do you have to call the right direction, it also has to be large enough of a move to overcome this volatility and time decay. So that is why trading earnings is difficult, and that's exactly why we want to show you the tool that's available to you that helps you make this type of analysis to decide, do I think this is a good idea for my assumptions or not, so that you can definitively say, do I think this is a trade that I want to make? And we want to show you how to do that very, very quickly using OptionsPlay. Obviously, if you pick the wrong direction, it doesn't matter whether this move is large or small, you will end up typically losing money on that trade if you call the wrong direction. So now that we've quantified and understand what are the different things working in our favor, which is if the stock goes in our favor, what are the things working against me, how do you actually go about quantifying these things? How do you know how much the stock needs to move in order for you to profit? How do you know how much volatility crush is going to affect the price of your option? How do you know how much time decay is working against you? These are the types of things that we want you to better understand. And in order to do that, we're going to explain option Greeks. For those of you that have traded before, you might be familiar with the option Greeks. For those of you that have not or are not as familiar, I want to make sure that you guys understand that this is a complicated topic. It's not something that's easy to grasp right off the bat. However, one of the great things about our platform is that you only have to understand it on a conceptual level. You don't actually have to know how to calculate it. You don't actually have to know how to do the math, because OptionsPlay actually does all of that work for you. So that's really the key here, is so that we help you do all of these analytics so that you don't have to manually calculate it yourself. So when we talked about the 3 different factors working in your favor, it really reflects in 3 different Greeks: the delta, the vega, and theta. So delta is telling you the change in the price of the option with respect to the change in the price of the stock. So if the stock jumps $10 higher, how much money do you actually make on the option itself? This is the part that's working in your favor. If the stock jumps in your favor or declines in your favor, how much money do you actually make on the underlying option? An example of delta is if you have an option with a delta of 50 or 0.5, that means for every dollar that the stock moves, your option will gain or lose 50 cents. So delta tells you the relationship between the stock move versus the option move. So this is how you measure how much your option price is impacted by a significant move in the underlying stock. Delta tells you that, okay? Now, we also said there's 2 things working against you. You have volatility crush and time always working against you. How do you measure that? That's what vega tells you. Vega tells you the change in the price of the option with respect to the change in volatility. So if you see an option with a vega of 0.25, That's telling you the option will either gain or lose 25 cents for every 1% change in implied volatility. So if you expect implied volatility to go from 20% down to 15%, that's a 5% loss in volatility. And in this particular case, that means you would lose $1.25 to this volatility crush. Lastly, theta. It's the change in price of the option with respect to time. Obviously, time is something that we can't control, so theta simply tells you how much of that time value you're losing every single day to time. So if you buy an option for 7 days, theta will tell you how much money you lose per day. You multiply this amount by the number of days you hold it, and that's the amount of money you will roughly lose by hanging on to that option for 7 days. So whenever I showed this type of slides, especially for someone who's new, I usually get the question, well, number one, where do I find the delta, the vega, and theta? And number two, how do I go about calculating these things? The great thing is that you don't have to do that anymore. OptionsPlay does all of that work for you. Not only do you not have to find what the Greeks are for each option, OptionsPlay will actually calculate the impact to the change of the option price based on any assumptions that you have. So that's really why as much as I want to explain these concepts to you, you only have to understand these on a conceptual level, because OptionsPlay, or the tool that you guys have available to you, actually does the calculations for you. Okay, so I want to make that very clear. I don't want to confuse anyone by showing you a lot of numbers and telling you have to do math. We do all of that work for you. So let's lastly talk about what are the trading strategies. Now that we know what earnings is, what our expectations going into next season is, how option prices are affected around earnings, let's talk about how do you actually take advantage of a bullish or bearish move. And we talked about two simple strategies: buying a call or a put. So buying a call or a put is an unlimited profit strategy that gives you unlimited profit potential, meaning if the stock goes to infinity or if the stock goes to zero, you're able to capture all of that upside to either side. This is a strategy that you would typically use if you expect a big move in the underlying stock. So especially, technology stocks, biotech stocks, these are the types of stocks you typically see big moves on earnings. These are the types of option strategies you would use for those types of stocks. And however, these types of strategies do typically put a larger amount of money at risk to trade them. So there's more risk involved, but you also have unlimited profit potential. So if you really get a big move, that's when you're likely going to be able to capture some big profits using these types of strategies. The second type of strategy you can utilize is a call vertical or a put vertical. Call vertical for if you expect a beat, put vertical if you expect a miss. Now, these strategies have limited profit potential, meaning a vertical has a defined amount of max reward. So you'd have that predefined before you get into a trade. These are the trades that you would typically expect a modest or a slower move in the underlying stock. So especially some of the big cap names like 3M or GE, these are the types of stocks that you would typically use a vertical for, because these stocks typically don't have huge jumps on earnings. However, they also provide you with a smaller amount of money at risk. So these are the two general strategies that you would take if you going into earnings seasons, that you would take if you expect either a beat or a miss. And again, you want to pick expirations that are usually 1 to 2 weeks after the earnings date for your expiration date at a very minimum. So let's actually start taking a look at some real life examples to show you these so that you can actually see these in action and come up with some ideas so that we can show you how to analyze these trades using the tool that's available to you. So like Scott said in the very beginning of the webinar, you can access OptionsPlay on the upper right-hand corner on the button that says OptionsPlay. If you don't have it, you can click on the Add Widget to add OptionsPlay as a tab. And we created OptionsPlay because we wanted to provide a better visual approach to analyzing, exploring, and trading options. And the reason for it is because when we looked at pages like this, we found it really difficult to try to decide which call or put we might buy, because even if you understood very well how to navigate these types of pages, things like the difference between should I buy the 190 or the 195 call, I couldn't really tell what my expected profit is if the stock moved up by 5%. I can't do those types of analysis just by looking at an option chain. We wanted to do that type of analysis because we needed that type of analysis in order to decide which strategy to trade. And that's really why we created OptionsPlay, to allow you to simulate different strategies side by side, do the Greek calculations for you so that you can see exactly what your expected profit and loss is, so that you can quickly decide, is this a trade that I want to make or not, okay? So the platform itself is divided into 3 sections. We have trade ideas and watch list here on the left-hand side. We have our security analysis panel here in the middle, and we have trading and income here on the right. So trade ideas and watch list is simply what symbols do you want to take a look at. The security analysis panel provides you with instant snapshot data so that you can quickly see what the current trends of the stock is, so you can see the 1-month and 6-month trend. We'll even display it to you below the chart so you can see how long the stock has been in a trend for and how those trends have changed. And we have what's called the technical score to give you a relative strength ranking so that you can have a quantifiable way to compare one stock to the next and say which ones are the strongest stocks in the market and which ones are the weakest stocks in the market. And then things like relevant things like earnings, dividends, and price action data are right here below your chart so that you don't have to go elsewhere to find this type of information. So as you can see, Eli Lilly reports earnings on July 24th, which is 15 days away. This is the type of information you need in order to trade earnings, to know when that next earnings date is, how many days away it is. These are the types of things that you need to help you select expiration dates and things like that. And lastly, we have trading and income here on the right. This is designed to provide everyone with a starting point with different strategies, regardless of whether you're a complete beginner to options trading and you just know how to trade stocks, to a simple option strategy like buying a call, or more complex option strategy like buying a call vertical. And you have 2 buttons here at the bottom. One says I'm bullish and one says I'm bearish. So when you click on I'm bullish, you'll be presented with 3 bullish strategies. If you click on I'm bearish, we'll be presenting you with 3 bearish strategies so that you can see strategies for all different types of views. Regardless of how you go about doing your analysis, you can type in any stock, click on either I'm bullish or an I'm bearish, and be presented with starting points. And this already has expiration date and strike price picked out for you. The call vertical and put vertical strikes are already optimized for you. This is designed to give you that starting point so that you don't have to pull up this type of page and just spend a few minutes trying to figure out where you want to start. This not only provides you with the starting point, but has the P&L simulator that allows you to quickly put in any scenario and actually, without having to understand how to calculate delta, vega, theta, immediately know what your expected profit or loss is. So actually, let's use Eli Lilly as an example, because this stock has earnings in 15 days. This is in a relatively strong sector, healthcare sector, that we said was a pretty strong sector going into Q1 earnings. So let's take a look at Eli Lilly, and let's say, let's just for 1 second say that we think Eli Lilly is going to beat on earnings. And I want to make sure that everyone understands that this is by no means a solicitation to trade Eli Lilly or to say that we think that they're going to beat on earnings. I'm simply using this for illustrative purposes to show you how you would utilize our tool to quickly analyze a bullish view on Eli Lilly going into earnings. So Eli Lilly is currently trading around 87. Here are 3 different strategies that you can take. Like I said, we looked at trading either a call, which is a little bit more expensive than trading a call vertical, but it gives you unlimited profit potential. So if the stock really takes off, you're able to take advantage of that, versus the call vertical has a max reward of $400. But it costs instead of $237 per contract on a call, it only costs you $200 on a call vertical. So that lowers your risk. That also lowers your break-even cost on the option. And these are all things that you need to put into consideration when you're deciding which trade to make. So Eli Lilly is trading at 87 right now. It reports earnings in 15 days. Looks like it's got a bit of resistance here around 89. So let's take a look at what happens if this stock goes up to 89. So like I said, we don't need to know the delta and then calculate it ourselves, because OptionsPlay does all of that for you. So what happens if the stock goes to 89 And we know that it reports earnings on July 24th. So let's say what happens a few days after earnings. So let's say on July 26th, the stock goes up to $89, which is not very high, only about a little over $1 above the current price. And we know that volatility comes down. Volatility crush comes down a little. So what happens if we assume the volatility comes down modestly? So here are the assumptions that we can make. So I think the stock's going to move a little bit higher by July 26th, which is a couple of days after earnings, and we know volatility always comes down after earnings. As you can see here, if you had bought the stock, you make a 1.25% return. If you bought this call, you actually lose 3.85%. So not a very good looking trade. If you bought this vertical, you make a 4% return. So in my opinion, none of these trades look very attractive. None of these returns look very great. So if you only expect Eli Lilly to move a little bit higher to just $1 higher, as you can see, this tool allows you to very quickly say, hey, this might not be the best trade to make. So meaning if you don't think Eli Lilly is really going to break higher, this might not be a trade that you want to trade going into earnings. However, if let's say you are a bit more bullish on Eli Lilly, maybe you think that this stock's going to head up to 91, 92, you think it's going to break above that 52-week high, which, yeah, looks like it's a 52-week high. So let's say you think it's going to go to 90 or 91. So let's look at what happens if that happens. Let's say it goes to 91 on earnings. As you can see, now the picture changes a little. If you had bought the stock, you make a 3% return. If you bought the call, you make a 60% return. If you bought this call spread, you make a 62% return. Again, this is making the assumption that the stock jumps to $91 a few days after earnings. And as we said, volatility always comes down after earnings. So we have to always make that assumption that volatility comes down a little. As you can see, the impact is not huge. As you can see here, it goes from 70% to about 60% return with the decrease in volatility. So it's not a huge impact, but it is something that you should be aware of because it does impact that stock price. So now, as you can see, you make a 59% return or a 62% return. And this is where you can go back to the drawing board and say, am I really bullish on Eli Lilly going into earnings? You know, and one of the things you can look for is the technical rank. The technical rank, which is the relative strength ranking, will give you somewhat of a template as to whether a stock is likely going to beat on earnings or miss on earnings. Strong stocks tend to beat or have a higher probability of beating. Weak stocks tend to have a higher probability of missing on their earnings. So you might have to go back to the drawing board and say, well, do I think that Eli Lilly is going to go to $89? If I do, this is probably not a trade that I want to make. If it goes to $90, well, now it starts to look a little bit more attractive, but maybe still not quite enough yield. So now you have to really say, well, this stock really needs to move maybe to $91 before it really looks interesting to me. So this is where you can quickly say, do I think Eli Lilly is going to go to 91 on earnings? If I do, certainly this is a trade that I might want to take a look at. If I don't, this also allows me to say, well, this is probably a trade that I don't want to make. And that's really the key part of OptionsPlay here. Not only do we want to help you find the right strategy to make, but also more importantly, we want to help you prevent you from making bad trades. The last thing you want to do is buy a call option going into earnings, the stock jumps a little bit, and then you realize I still didn't make any money on this trade, and you don't realize it until afterwards. We want to make sure you understand that risk before you get into a trade, not after. Okay, so this tool allows you to really create any different scenario and see what your expected profit is, what your expected losses are. So what happens if Eli Lilly misses on earnings? What if it goes back down to this 83 level? What are our expectations? So what happens if a few days after earnings, the stock goes down to 83, volatility comes down a little. As you can see, if you had bought the stock, you lose a 5% return or $490. If you bought this call, you lose $222. If you bought this call vertical, you lose $185. So you lose a smaller amount of money if you buy this call vertical and the trade doesn't go against you. If the trade goes against you. And if the stock goes in your favor, you can potentially make a higher return on this call spread, depending on how far the stock moves. So this tool really allows you to play around and see the different scenarios so that you can exactly determine what your expected profit is, what your expected losses is, so that you can decide which one you want to make. So if let's say you think the stock's going to really take off, you think it's going to go to $93 by earnings, and you see that this call strategy returns you 135% return, and you say, this is the trade that I want to make, one of the great things about the integration we've done with Regal Securities is you can trade directly from OptionsPlay. You can hit the trade button, hit the preview order button, and that actually pre-fills your ticket for you so that you don't have to pre-fill these tickets manually. You can simply select the order type that you want to use and click on verify to send off this order. This allows you to really look at a trade, analyze it, and if this is a trade you want to make, be able to trade it directly from OptionsPlay. Okay, so let's take a look at another example here. 3M. This is a big cap name. It's in the Dow Jones 30. As you can see, it's got a very weak technical score telling me this is a relatively weak stock in the overall market. It's underperforming the overall market. 1 month and 6 month trends are bearish. As you can see, it's been bearish for quite some time. So this might be a candidate for perhaps a miss. Again, this is not by any means a solicitation to trade 3M. This is just for illustrative purposes to say, if you're bearish on 3M or if you think 3M is going to miss on earnings, here's how you can play this. So here I've selected bearish. 3M actually reports on the same day as Eli Lilly, July 24th, which is 15 days away. Here, you can short the stock if you don't trade options, which I don't necessarily recommend people to do because you do have unlimited risk if 3M really takes off. You can buy a put option, which only costs you $725 per contract, or you can buy this put vertical, which costs you only $575. So like I said, when you're talking big cap names, they don't tend to move as much during earnings. You may want to look at a strategy more like a call vertical versus if you're looking at a tech stock or a biotech stock that maybe have huge moves on earnings, you might be better off trading that call or a put. But this tool really allows you to put these two strategies side by side, go through different scenarios, and actually decide which one's best suited for you. So let's take a look at Eli Lilly. This was just trading at 190 just a few days ago. So let's make that assumption of what happens if it goes back down to 190 a few days after earnings. So earnings is July 24th. So what happens if on the 26th or 27th, and we know volatility comes down after earnings. So let's take a look at that. So what does that look like? If I had shorted the stock, I make about a 5% return. Which is good, but not super attractive, right? If I bought this put, I'd make a 76% return. That looks pretty attractive. And this is a stock, and that's just going back to the price that was trading a week ago. I don't even necessarily think it needs earnings for that stock to move $7 lower. That can happen in a week just naturally. But if I bought this put vertical here, I make a 99% return. So significantly higher return by buying this put spread versus these two while limiting my risk. So when I buy this put, my losses can be as high as $725. When I buy this put vertical, I'm only limited to $575. So almost a 20% reduction in risk by trading this call spread, this put spread. And what that translates to is a higher return if the stock does go in my favor. So 3M goes down to 190. As you can see, I'm making a significantly higher return. And I think 190 is a fairly conservative investment because it was just trading there just a few days ago on July 2nd. On its own. So if you're really bearish on this trade, it's not that crazy to say that I think it's going to go to 185 or maybe this 188 level. If you see, as you can see, if the stock goes down to 188, which is about $10 lower, a few days after earnings, a 6% return on the stock, 102% return on the put, 121% return on the put vertical. Okay, so then you can ask yourself, how bearish am I on 3M? How much lower do I think the stock's going to go? Like I said, this really allows you to create different scenarios and see exactly for yourself what your expected profit and loss is so that you could definitively say which strategy is best suited for you. And conversely, what happens if the stock takes off? What happens if it beats on earnings and goes back up to this 205, 206 level here? What is this, 207 or so? So what happens if the stock beats on earnings and goes back up to 207? As you can see here, I'd lose about $700 if I had shorted the stock. I lose $548 if I bought this put. and I only lose $399 if I put this put spread. So again, having this put spread that allows you to take this bullish or bearish view with smaller amounts of capital at risk really allows you to take these bullish and bearish views on the stock going into earnings with limited risk and still a very nice return if the stock does go in your favor. And lastly, if you decide this is a trade you want to make, you can hit that trade button. It even provides you with the strategy checklist just so you understand your risks before you place your trade. And once you're ready to do that, you just hit the preview order button and it pre-fills that ticket for you so that you can send it off for execution immediately. So this is really the tool that allows you to create any settings that you want. You can use this tool even without earnings. Even if you don't expect earnings to happen, you can use this P&L simulator to say whatever scenarios you expect the stock to happen, what your expected returns and losses are, so that you can decide which strategy is best suited for you. So I just have one last example to use. American Express reports earnings very soon in about 9 days. So for here, like I said, I usually like to trade earnings that are about 2 to 3 weeks beyond earnings. So if I'm looking at American Express, which reports earnings in just 9 days, I may not want to look at that August call or put. Maybe I might want to look at a slightly shorter dated one. So maybe I might look at a July 27th or an August 3rd. So you can click on modify for any of these strategies and change the expiration date. So maybe I might want to look at a July 99 put versus, and this really allows you to create all different types of scenarios. So maybe you want to compare a 99.5 put versus maybe a 101 put. Or 101 call rather, sorry. So this allows you to actually now compare not just a call to a call spread, but maybe one strike to another strike or one expiration to another expiration. There's no limit to what you can do here. You can create all different types of strategies and compare them side by side. So maybe you want to compare a July 99.5, 101, and maybe you want to select an in the money call, maybe a 97.5. You want to see what the difference between an in the money, at the money, and out of the money call is. This allows you to create any three scenarios and say, well, American Express is trading at about 99 right now. I think it's going to beat on earnings and maybe go up to 102, 103. So let's say what happens if it goes to 103 a few days after earnings, which is on the 18th. So let's say on the 22nd, the stock jumps up to 103, and we know volatility always comes down a little. What are my expected gains? So this allows you to pull different expirations, different strike prices, and actually see what your expected profit is. So here, if you had expected the stock to move up to 103, it's telling you that this strategy here in the middle, this at the money call, is going to give you the best return. Conversely, what happens if the stock really takes off? What happens if it goes to 105, 106? As you can see, this out of the money strategy gives you the highest return. So this really allows you to play around with different strategies, use the P&L simulator so that you can see exactly what your expected profit is, what your expected losses are, and you can play around with all of these strategies, change the expiration date, the strike prices, even the strategies themselves. So if you don't want to compare a call to another call and you want to compare a call to a vertical, you can do that instantly by clicking on this, setting up the vertical that you're looking at, and using the P&L simulator to say, what are my expected returns, so that you can quickly see, hey, in this particular scenario, I might be better off trading this this call vertical because it gives me that higher return if the stock goes in my favor. And once you do that, clicking on the trade button allows you to preview that order, pre-fill that ticket, and send it off for execution whenever you're ready. So with that, I just want to do a quick recap. Earnings season is coming up. It certainly is potentially a very exciting time, especially in this time where we have a lot of rhetoric around trade wars that have kind of dominated the headlines. It's really good that corporate profits is back in the headlines again. We expect a relatively strong quarter, and we expect relatively muted beats, but we do expect to see some pretty big declines on stocks that miss earnings. So that actually is where I think a lot of opportunities are, is potentially for these crowded stocks that maybe don't guide as high on earnings, really see some big down moves to the downside. So using options is a great way to play this with limited risk. But like I said, it is risky, it is difficult. So make sure that you utilize these tools so that you can know exactly what your expected profit and loss is before you get into a trade, not after, so that you know, hey, if I expect the stock to move this much, what are my gains, what are my losses? Sometimes you'll find that even if the stock moves significantly, you don't make a lot of money on those options. And that's really why we have these tools for you, so that you understand those risks before you place your trade. So perhaps you simply just don't place those trades to begin with and potentially lose money on the other side. So with that, I want to thank everyone for joining me this afternoon. What I want to do now is I want to open this up for Q&A. So if you have any questions regarding anything I just spoke about with the earnings, please send them into either the chat window or the Q&A window, and I will answer as many as I possibly can right now. So first question, can we assume the expected move based on the trading range simulator? So yeah, that's exactly what our trading range simulator does, is it looks at the implied volatility of the option and simulates what the expected move for that option expiration is. So you always want to choose the option expiration closest to the earnings date. So here, for example, on American Express, the earnings date is July 18th. So the closest date we have here is the July 20th. That gives you an idea as far as what the expected move is for that stock, based on what the earnings market is implying. Question here by Bo. Could you please explain the technical score, how one can determine whether a company is going to show strong earnings? So the technical score is not meant as an earnings indicator. However, the technical score is a relative strength indicator. And relative strength historically does have some correlation to earnings. So strong stocks, meaning strong stocks that are outperforming the market, tend to have a higher probability of beating on earnings, and stocks that are underperforming the market significantly tend to have a higher probability of missing on earnings. So when you type in any stock, so for example, we look at, let's see, Facebook, it's got a relatively strong technical score. It typically has a slightly higher probability of beating on earnings versus 3M that has a very low score, meaning a stock that's underperforming the market tends to have a higher probability of missing on earnings. Great question. Pat's asking, on 3M, your strategy expired the day of earnings. Wouldn't you want to go out at least a week or more? I don't believe so. I believe I was looking at the August 24th. So I was actually looking at an expiration that was a full month beyond the earnings date. The earnings is July 24th. I was looking at the August 24th. So plenty of time between now and expiration. You might even want to adjust this a little bit in. You might want to look at the August monthly expirations. So just about, what is this? 15, 20 days after the earnings. So you can play around with the different earnings, but I usually recommend going at least 2 weeks beyond the earnings date. So July 24th is 15 days out. The least I would go out is probably August 3rd, if not August 10th, trading this 3M example. Bobs, could you please expand upon the trade ideas in the left column? How do we use that to choose stocks to explore? So it's very simple. Depending on whether if you're looking for bullish or bearish ideas, you can use this to filter for bullish ideas or bearish ideas. I usually tell users to look at, first of all, the overall market first. What is the market trending? Is the market trending higher or lower? So in this particular case, the S&P 500 is trending both bullish on short and long term. Then I usually like to look at the individual sectors. So, for example, if the market is trending bullish, I'm likely going to be looking for bullish examples. I always tell users to sort by the score. That's this technical score that I'm referring to here. If you're looking for bullish examples, you generally want to find stocks with higher scores. They tend to have a higher probability of the stock moving higher. And then you might want to choose a sector in the sector that you think is strong. So technology is obviously a very strong sector right now. This allows you to quickly look for strong technology stocks that are bullish. So here's, let's say, CenturyLink. Here's a name that I think most people recognize. This is saying to take a look at CenturyLink. And what this does is it provides you with the analysis of the underlying stock, and then lastly, a trading tab to show you how to actually take advantage of a bullish move on CenturyLink. Looks like the internet here that I have is a little slow here. So as you can see, so once I've looked at CenturyLink, If I agree with everything here and I think that CenturyLink's going to move higher, then I can see what are my trading strategies here. So I can buy the stock, I can buy this call, I can buy this call spread. This allows you to quickly look at what is the viability of trading this. And one thing I want to point out is that, when I'm looking at these trade ideas, especially if you're trying to trade options, you generally may not want to look at small cap and medium cap. But keep in mind that this is not just for stocks. This is not just for options traders. This is also for stock traders. So if you're looking for ideas, these ideas span both stocks and options. But if you trade options, I typically recommend looking more on the large cap and mega cap stocks, because the small cap and medium cap stocks, the option markets usually aren't very liquid. So if you're looking at the small cap and medium caps, you're typically better off just trading the stock. If you're looking for option strategies, I usually like to filter by large cap and mega cap first, so that I'm usually looking at stocks that typically have relatively liquid options to look at. So that's how I typically would use the trade ideas tab for finding new ideas. How far ahead of the earnings date should the play be set up? Great question. So Charles is asking, how long before an earnings date should you enter a trade? That's actually a great question. And this is really where this concept of time value is really important, because the longer you hold on to a trade, the longer time value is going to affect your option pricing. So you typically don't want to enter a trade more than 2 weeks before earnings. Usually the first week or two before earnings is when you want to enter the trade. That is the general time frame that you want to use. If you enter a trade a month before earnings, then you have this whole month of time value eroding, basically eating away at your profits. So that's really usually why you don't go a month out. But usually 1 to 2 weeks out is usually where you would enter a trade before earnings. Bo's asking, could you please show us how to sell a call instead of buying a put? Yeah, very simple. You click on modify, you can click on sell a call, and you can just do that. So I wouldn't sell a call going into earnings, because that's not a great way to play earnings, but that's how you go about selling a call if that's what you're looking for. What are your thoughts on buying a call and a put and then selling the option that is betting on the wrong direction once earnings are confirmed? You can certainly do that, but one of the things about earnings is that when you go into earnings, the straddle or the strangle is going to be very, very expensive. So as you can see, let's go back to American Express that actually has earnings coming up. It's trading at $99, right around the $100 mark. So let's say you want to buy a $100 straddle. As you can see, this costs you $625 to buy the straddle, which means that American Express needs to either go to 106 or higher just to break even, or about 103.75 to break even. So you have to have 93.75 or 106.25. So you have to have such a large move in order for that strategy just to break even. So that's usually why buying straddles going into earnings typically is not a great idea, just because of how much the stock needs to move. However, if you find that the straddle is very cheap and you think the stock's going to make a very large move, so for example, if you think American Express is going to move $10 on earnings, then yes, absolutely, you can buy a straddle. But generally speaking, you're better off picking a specific direction and just buying a call or a put. That's not to say you can't trade the earnings using the straddle, but historically speaking, if you buy a straddle, you're likely going to lose money in the long run. Would an iron butterfly strategy beat IV crush in time decay? How would you set that up? Great question. So you can use an iron butterfly. So depending on whether you want to use a neutral iron butterfly or let's see, let me set this up so that it's an even split. So yeah, absolutely, an iron butterfly would be able to take advantage of that IV crush and time decay. However, that requires the stock to stay where it is in order for you to be profitable. So this really depends. So if you think the stock's not going to move anywhere and you think it's going to stay exactly where it is, an iron butterfly is certainly one trade that you can do that not only captures the fact that the stock doesn't move, but more importantly, that IV crush and that time decay. So you can say that, as you can see, if the stock stays exactly where it is, that actually will as the volatility of that crush comes down, you actually make money on this iron butterfly. As you can see, as volatility goes down, you're making more and more money on this iron butterfly. And as time goes on, you actually make more and more money. So this is really where you can use these sliders to actually learn more about how time and volatility affects each strategy. So if you have this iron butterfly, as you can see, if the stock stays where it is and time goes by, you make more money. And as volatility goes down, you also make more money. So absolutely. But again, like I said, this is only a strategy if you expect the stock to stay where it is, because if the stock moves, you're going to lose money on an iron butterfly. If it moves in either direction, you're going to lose money. Typically, earnings, you expect a move, but if you don't expect a move, then you can certainly trade an iron butterfly. Great question. Someone showed me their Thinkorswim platform, which is something Thinkorswim calls IV percentile. It tells you the percentage of times in which the stock's implied volatility is lower than the current implied volatility. Is this OptionsPlay going to have something available? So there's a reason that we currently don't offer this, is because IV percentile only tells you where it is compared to history. It doesn't tell you where IV is going to be in the future. It doesn't tell you whether IV is going to go higher or lower. And I think that's one of the major, I could say, limitations of IV percentile, is that just because it's high doesn't mean it's going to go lower. And I think that's there's this oversimplification of volatility that people tend to use now, that if volatility is high, that they expect it's going to go low, or if it's low, they expect it to go higher. And that's simply not true. Or certainly not true enough where you can rely that on a trading strategy. So that's really why we don't offer it. It's something that I plan to try to provide in the future. However, the IV percentile is not enough for you to trade on. And part of the reason for that also is because, as I showed you here before, let me go back to my American Express example. Let's reset these strategies here. And let's go back to the implied volatility example. So if volatility is at 21% right now, and it's let's say I say that that's a 90 percentile, and I think it's going to go back lower. As you can see, the impact actually. So for example, if this stock moves up, I don't know, to $105 on earnings. Sorry, 105. And volatility goes from 21% to 18%. As you can see, my return moves from 80% to about 70%, a very small impact to your overall gains and losses. It's important to understand this concept, but it is by far very, very small component of your gains and losses compared to what delta is. So for example, if the stock moves from 104 to 105, it's a 46% return versus a 70% return, a much, much larger impact. Just a $1 change has such a much larger impact to what you're actually gaining and losing on the trade. That's really what you should be most concerned about. Volatility is actually a very small component, but I tend to see people put an outsized I would say, influence on volatility, when volatility has a relatively small impact on the actual option pricing. The delta has a much, much larger, and that's really what you should be focused on. And that's really why we spend a lot of time trying to understand what the current trend of the stock is, what the relative strength of the stock is, because the direction is really what impacts your P&L at the end of the day. Volatility can certainly give you a small edge, but that edge is very small. And that's why we don't want to confuse people by just showing you an IV rank that's high or low and prevent you from making the right trades, because a lot of times people will say, I only want to trade a credit spread when the vol is higher. I only want to trade a debit spread when the vol is low. But that's not, in my opinion, the right thing to do. What's the right thing to do is actually understand what's your directional view and pick the strategy that's best suited for your directional view, not what strategy is best suited for the volatility view, because the volatility view, again, has a very small impact on your P&L overall compared to what the delta actually provides you. So that's my overall view on volatility, and we don't have it because we don't want to overcomplicate your life by adding another thing to think about that has relatively low impact on your P&L overall. Great question though, and I'm sorry for the long-winded answer, but you know that is my general feeling on the concept of volatility. Last question, is asking, can you go over what the play score is? I think you're referring to this options play score, and that's a great question. The options play score is telling you what the risk to reward of each strategy is. And the reason we created this is because if you look at a page that looks like this, and it tells you that buying a stock has unlimited max reward, but a max risk of $10,000. This call strategy has an unlimited max reward of, but a max risk of 345. And this strategy on the right has a max reward of 547 and a max risk of 303. How do you actually compare these three? They're completely different strategies. They have very different max reward, max risks. You can't even have calculated risk reward ratio on these types of strategies. So how do you actually compare them? And that's really why we created the options play scores. We wanted to give you a unified way to actually compare strategies apples to apples and understand what is the actual risk to reward of each strategy. And it's all color coded for you so that you don't have to necessarily memorize what's a good score and what's a bad score. You just need to know that the red score is telling you that it has a relatively poor risk to reward ratio. Yellow means average and green means good risk to reward. So here, as you can see here on this bearish trade here, I have a higher risk to reward versus these other two strategies. So it's just all color coded for you so that you get a feel for what the risk to reward is and allows you to compare different strategies side by side. Sherry's asking, does your system show what stocks are ready for a big move? Sherry, if I knew what stocks are ready for a big move, I probably wouldn't be sitting here talking to you. So like I said, there's nothing in the world that can predict whether a stock's going to move or not. However, like I said, relative strength has shown to give you an idea as far as what stocks have a higher probability of beating or missing. And like I said, the stocks that are relatively more volatile, like healthcare stocks, biotech stocks, technology stocks, these are the types of stocks that typically have big moves on earnings versus stocks like GE and Coca-Cola and Pepsi and 3M. These large cap stocks typically do not have as large moves during earnings. So the size of the stock and the type of stock typically dictate that. The cost of the system is free of charge to you because it's free of charge with your Regal Securities account. So that's why I highly recommend every single one of you, when you log onto your account, you have access to it free of charge. Utilize the tool. It really helps you better understand your risks and reward before you go ahead and place a trade. So Sherry, you have access to it already through your Regal Securities account. Any other questions? If there's no other questions, again, I want to thank everyone for taking the time out this afternoon. I hope you guys have found this webinar useful in helping you understand how to analyze each trade, both for earnings and even if you're not trading earnings, how to utilize the P&L simulator to better understand how a movement in the underlying stock and time affects your option strategies so that you can better define your risks and reward before you place a trade. That's the key here, understanding what your potential reward is, what your potential risks are before you place that trade so that you're not surprised after the fact that you get into a trade and the stock moves and you're not getting the expected profit or loss in your account. So hopefully you guys have found this useful. And lastly, once you've decided you want to place that trade, make sure you hit that trade button because when you hit the preview order button, it pre-fills that ticket for you, makes your life a lot easier. And it makes sure that you don't put in anything incorrectly. There's a lot of parameters on this page. Sometimes you might enter something incorrectly. We want to make sure we minimize those types of mistakes. So by pre-filling the ticket for you, we really help you minimize those mistakes. Thank you everyone for all the comments here. When do you recommend closing a call vertical when profitable or going against you? Great question. So Kevin, the rule of thumb that we generally have when you're buying a call or a put or a call vertical or put vertical is all the same. We usually, as a rule of thumb, tell you to close your trade at a loss if you've lost about 50% of the premium that you've paid on the option, and take profits if you've reached anywhere between 75 to 100% gain on that call or put, or that call vertical or put vertical. So 50% loss on the downside, 75 to 100% gain on the upside. If you're trading multiple contracts, you can always take partial profits. So if you're trading 10 contracts at a time and you've reached that 75 to 100% gain, you can take half those contracts off and leave a few on for potentially more gains, but you usually want to at least start taking some profits once you hit that 75 to 100% threshold. Great question, Kevin. Any last questions before I sign off?
Great. Well, thank you very much, Tony. This is great stuff, especially as we kick off earnings season here, and just a lot of great features and tools at our fingertips here with OptionsPlay. And so if anybody else has any questions, please reach out to your broker customer service team, and they'll be glad to help address any of your questions. And with that being said, just a reminder, you can find your OptionsPlay tool just across the tabs on your platform. And our next webinar is actually this Thursday. It's Options Core Concepts. So anybody who needs an introductory to options and the basic terms and contract terms and executing option trades, be sure to be on the lookout for your email coming in the next day or so for a webinar for this Thursday at 3:15. Okay, thanks again, everyone, and have a great rest of the day. Bye-bye.